let's kick it off. So my name is Mary Rada. I'm the marketing manager with Ximplifi, and I have the pleasure of being your um, interviewer today. And we're here today to talk about financial secrets to selling your vacation rental management business. Jesse Arrett is our founder of Ximplifi, and Jacoby Olin is the president of C2G Advisors. So I'm going to go ahead and let them introduce themselves. This is a topic that we found to be really top of mind at the Extravaganza conference this week. And we're excited to go even deeper into it. So I'll let Jacoby introduce C2G.
Thank you, Mary. I'm Jacoby Olin, the president of C2G Advisors. We are M&A advisors specifically here in the short-term vacation rental industry. Most of the deals that we do are buy-sell transactions for property management companies and technology providers. We've been fortunate that the last kind of 18 months of M&A in the industry has been just absolutely wild. And we see that continuing for at least the midterm future.
Hey, Jacoby, I know we might get into this a little bit, but we're keeping this a little conversational. So I just thought I'd ask, interest rates just got increased yesterday. I'm assuming that we're seeing that have some effect on valuations of companies and M&A, action, or what are you saying?
Yeah, no, that's a good question. There is obviously these macroeconomic headwinds happening internationally, but also just in our country with interest rates on the rise, stock markets falling like crazy compared to last year.
Yeah.
With obviously the war. So there is a lot of kind of worry going on out there. However, our industry still has incredible tailwinds from kind of how it's thrived during COVID and the new exposure on the industry.
Yeah.
But we definitely have had some people asking questions regarding interest rates and getting debt financing and stuff of that nature. And it remains to be seen. We, as of today, right now, M&A is still as rampant as it's ever been. So, but I don't want to be naive to not think that it'll likely have some effect in the coming future.
Right. Yeah. No, makes sense. I mean, to your point, our clients continue to grow and see good results. Maybe not quite as crazy as 2021, but same thing. So sorry to derail, but I thought after that comment and considering the announcement by the Fed yesterday, I thought it was appropriate to get your take on that.
Yeah.
Yeah, no, thank you. I mean, tomorrow maybe everything screeches to a halt, but so far we're okay.
Right, I doubt that. Well, I'll go ahead and introduce myself. My name is Jesse. I am the CEO and founder of Ximplifi. We founded our business 4 or 5 years ago to provide outsourced or professional services to small, medium-sized businesses. We specifically targeted the vacation rental market, as I had extensive experience as a CFO for a global real estate fund and property management company. And so with that experience, that's where we hung our hat, so to speak. And so whether it's leveraging and optimizing accounting software and other applications, integrating your accounting system with your property management system to streamline accounting, provide better insight and reporting, or whether it's us becoming your fully outsourced accounting and finance team, we really try to bring both the technology and the accounting finance services component together to help businesses in this industry thrive and achieve greater financial results. And because of that experience, we've been involved in helping some of our companies go through sale transactions or been brought in to do different due diligence for companies that are looking to sell. So anyway, I've talked with you, Jacoby, several times and worked, and talked about different deals and stuff. And, just to give a little breath of, hey, where this started, it was us, chatting about, man, the challenges of getting the right financial information for companies that want to sell, and understanding early the importance of financials in creating the best valuation for your company. So anyway, excited to chat today about these topics.
Yeah, that is so true, Jesse. And I think it's a topic that everyone has questions in their mind about, but not a lot of answers. So this is a really key thing to talk about. Here's an overview for everyone on with us. Thank you for joining this morning. I think I saw a couple more. But we are monitoring the chat. And if you have a question for us, we want to answer what's topical for you. So please feel free to type those in. We'll be monitoring it so that we can ask either Jesse or Jacoby, or pitch it to both of them. Yeah, and at the end, we will also have time for Q&A. And for anyone who couldn't make it or had a late flight, we will be sending out the recording next week. So let's get started. Our first question is going to be directed to you, Jacoby, and it's a big one, but I'm hoping that you can help us unpack it a little bit. So where do they start? Where does a vacation rental manager, what's the first thing they need to do when they are thinking about selling their company?
Sure, and that's like you said, is a great question, and we could probably spend the whole rest of the time unpacking this, but I'll try to keep it relatively short. There's the old adage of begin with the end in mind, and that rings very true with looking to sell your company. So whether you're looking to sell tomorrow or in 3 years from now, there's a couple of things that you can focus on. The three most important items that buyers will be looking at in order are your financials. So making sure, and we'll unpack this in greater detail throughout this, but making sure you have 3 years of financials broken out by month. The next part is your contracts. These are the assets that are being sold in this business. So making sure that you have assignability clauses in every contract, because the majority of these deals are asset-based deals. Making sure you have an auto renewal clause, making sure if the homeowner can terminate, that there is a hook in there about the commissions on the future reservations are going to the property manager. And thirdly, making sure that your staff is super important in these deals. And you want to slowly start to remove yourself from the owner relations role, and then also from the general manager role as you start to grow. The owner relations part first. You do not want all the homeowners to have your cell phone number. And so start to try to hire for that position. And by doing that, that'll just help you not have to assist with transition for several months or several years post-close. But really honing in on the financials, the contracts, and the staff are paramount. What you can do on the front end is also talk to advisors. And so starting with a CPA firm to understand kind of the effects, the taxation effects of what a deal would look like for you, whether it's stock versus asset, where the capital gains versus the ordinary income is going to come in, whether you're closing this year or next year. Also speaking with an attorney to understand the contracts and how the purchase and sale agreement will look, and then talking with a financial advisor as well on the front end, because you might be 30 looking to sell and looking to kind of roll that money into another venture, or you might be 65 and looking to kind of get your nest egg or have some money for your children. So those are a couple of things that I would say very high level. Also to think about the timeline. A deal typically takes about 3 to 6 months to close from like start to end. So if you want to sell by June of next year, then you might want to start the process in January or something of that nature. So you can kind of go back and look at that.
Okay, awesome. That is a lot of information. So we're going to definitely crystallize that into a checklist, and we can send that out to our attendees so they can keep all of those things in mind. One of the important things that you guys have already touched on is what the market looks like right now for vacation rental managers. Is it a buyer's market or a seller's market right now?
Yeah, it's a great question. And to Jesse's first question about the interest rates, like this could flip really quick. And I want companies to understand that it is definitely a good time to be a seller because there are more buyers and investors than ever before. However, these buyers and investors will require professional companies. So they want to make sure that these financials are clean. A lot of these buyers, they hire an outsourced quality of earnings company to come in during due diligence and take a look at the financials and make sure they'll go line by line and try to understand all the revenue, all the COGS, all the expenses, what are recurring, what are one time, all of that. So yes, I think it's still a seller's market, but you need to have your house in order. That's for sure.
Definitely. And that feeds great into my follow-up for Jesse. You know, you mentioned due diligence on the financials. So what are the ways that Ximplifi helps a client go through that process, you know, and make sure they're doing it accurately?
Right. Yeah. Well, I think, for us, we get engaged with these items sometimes when they're our own client. Obviously when they're our own client, their house better be in order or we're doing a really bad job. But that is really important for us because we're making sure that their accounts are always reconciled. We're making sure that they're booking revenue on an accrual basis, that they understand each piece of different types of revenue, because those are things when we talk about an asset sale. Well, the asset is the contract, and the value of the contract is essentially the discounted cash flows of that contract. Meaning, hey, if I bring in $100,000 in revenue for a year on a certain home, well, what's my average management commission? Or even, when going through due diligence, they'll go down to that actual contract and say, hey, well, contract on this is 20%, maybe the next one's 17%, maybe the next one's 25%. So they're going to understand exactly the metrics. What is your management company revenue, which is those commissions, as well as cleaning revenue that you've been earning, as well as any maintenance or other ancillary other guest charges that flow to you as the management company. So that's really what we come in and do is help companies put all that information together, combining their property management system and their accounting system, to do almost a light Q&E before a real Q&E comes in. Because if books in the house aren't in order before when the Q of E comes in, and then they start finding a bunch of things, it just can really, we'll get into the pitfalls later, but it just doesn't end up going well. You can start to have the buyers asking a lot of questions. And so we typically, again, if they're already a client, we're largely just putting together different reports and pulling things together to help the broker understand the valuation of the company. If they're not our client, we're going in and doing some light Q of E analysis, making sure their trust accounts are reconciled, their banks are reconciled, credit cards are reconciled, P&L for the last 3 years appear in order and reasonable. So we'll do some light analytics, but that's typically what we're doing as we help prepare these companies for sale.
Awesome. Yeah, and you brought up something that leads us into our second question. The buyers do have a lot of questions and they want to know the details. I think it was Jacoby or his counterpart at Extravaganza that said, they're going to look behind it when they're going to submit an offer, and then they're going to tear that curtain away and they're going to go through it with a fine-tooth comb. So we just wanted to touch on this for our audience out there. Jacoby, what types of buyers are out there right now, and how do they get connected with the seller?
Yeah, thank you, Mary. And that, I was literally going to say that sentence, so you stole the peak in curtain one.
Sorry.
No, that's awesome. Okay, so there are many different demographics of buyers right now in the industry, which is great for sellers. There's not just one or two like there was maybe in the 20 teens. Each one of these buyers, though, is going to have a different investment thesis. And where that typically starts out is geographically focused. So a buyer might be interested in Orlando, or they might be interested in Nashville or beach, mountain, or ski. So they're all going to have different kind of criteria there. And then on top of that, they'll have either EBITDA minimums or maximums. They'll have unit count minimums or maximums. So they're going to all have these different parameters. So you might be perfect for ABC buyer, but a terrible fit for XYZ buyer. So just understanding that. And so the actual demographics of these is we have like the VC backed ones, the venture capital backed ones. And these ones, they typically have brand uniformity across the state. So they're more or less kind of one brand. They're working on this guest facing brand, like a Marriott or something of that nature. And they're going towards the public markets, or they're already public, and they're looking at typically either your bottom line, your profits, plus they're also looking at your revenues as well. Because some of these buyers, they're already either national players, or they might already be in your market. They might have the infrastructure in your market. So they might not care as much about your profits as they do about your revenues, because they can layer in their own margins on how they operate. So that's the VC backed ones. And then you have the private equity backed companies. And some of these have been in the industry for 5 to 10 years. Some have been in for the last year, and some are trying to acquire their first platform company in the industry. And these are typically more brand agnostic. They're more or less a collection of different brands, and they are focused on your bottom line. They're going to be cash flow earnings buyers. A lot of them do like sellers to kind of roll over some equity and continue operations with them post close. So that's another kind of interesting component that I don't have to focus on too much, but they're more quiet with their acquisitions, whereas VC backs they'll typically do like press releases or something like that for their shareholders. And then the third group are these just strategic, larger brands, either in your market or in complementary markets or ancillary markets, adjacent markets that are just looking at growing by adding another brand, or by kind of tucking you in if they're larger than you. But that's kind of a little macro who the buyers are out there.
Gotcha. Yeah, that helps breaking it up, kind of thinking of those different groups. And then I'm sure within those groups, they each have a specific ideal buyer or a ideal type of property or type of company in mind for their segmentation, probably, right?
Well, and I sorry to interrupt, but I think too, as a seller, really thinking through, hey, who's your ideal buyer? Because, in that private equity family office, as Jacoby talked about, you're probably going to want you to stay on with that new company. And so that's where you're in a situation, you're like, hey, I've got a really good thing going. I really love what I'm doing. And I just want to take what I'm currently doing and have some growth capital, as well as probably take, some of the valuation off the table and put it in your pocket, so to speak. But still stay with the company and continue to grow. Or the venture capital or the strategic operators, probably a little bit more, most likely, hey, that's going to be some sort of exit where, at minimum, with 1 to 2 years or maximum 1 to 2 years, you've exited that business, if not sooner.
Thank you.
Yeah, great point, Jesse, and that's kind of what we're getting at here. Like, sellers do have a lot of options right now if you are building a strong and sustainable business. Yeah, I think that's a very good point.
Absolutely. Let's go on to question 3. This one, you guys have a lot of experience with these deals, so I think it feeds right into you guys just kind of sharing some of your experiences. What are some of the reasons that you've seen a deal go south, or that we can obviously use as a stepping stone? So Jacoby, let's start with you. What comes to mind when you think of pitfalls?
Yeah, sure. And
pain, right, Jacoby? Pain.
100%. So, as I mentioned at the beginning, these deals take 3 to 6 months to transact, sometimes longer than that. So if you've gone 2-3 months down the road with this potential buyer, and then all of a sudden things start coming up that you might not have even been aware about, like, that's awful. That's a terrible feeling for both the seller, both the buyer. I mean, you both put in a lot of time and capital in that. But yeah, just backing up, like what you mentioned at the beginning, Mary, is like how a deal goes is the buyer, they'll get some initial information, or they'll take that peek behind the curtain. They might get some of your P&L, some of your booking reports. And then once with that information, then they submit an offer, an LOI, and you might do some back and forth negotiation. But once that thing's accepted, then the curtain comes down and you are fully exposed. That buyer is going to look through every line item on your financials. They're going to look through every contract you have. They're going to look through any old lawsuits you have. But financials are really the main component. So not having clean financials is going to hurt, and it's going to hurt a lot. And what I mean by that to an extent is we've seen companies that have one line item for their revenues. It literally says total income. And we had a deal where a seller had that total income, and let's say it was $5 million. Once due diligence started, we found out that seller had their advanced deposits inside of that total revenue line item, which that is not a profit and loss. That's not a P&L line item. So the seller was inflating their business by about $1 million that the buyer found out 3 months into the deal. And the buyer ended up retrading, and then the seller emotions got involved, and then both sides walked away. And the seller did not have a clue that was inside of there. So definitely breaking out your P&L by revenues, by the direct COGS associated with those revenues are paramount. And you don't have to be all these owners. We're all entrepreneurs. We're all hustlers. We're kind of all pirates. Otherwise, we'd be in more normal industries. So you don't have to be a CPA to be the owner. You don't have to be a financial wizard or guru, but you do need to understand what your P&Ls are telling, and you need to hire for that, whether it's an outsourced firm or internal or a mixture of the two. Like, that is paramount to have those in order.
Mm-hmm.
Yeah, Jesse.
Yeah.
Anything else?
Well, I think I'll just elaborate on a few things that Jacoby just talked about, and I would say certainly north of half of the clients that come to us are literally just taking cash in to revenue, which we've got a sample P&L that we're going to jump through here in just a minute. But as Jacoby talked about, when cash comes in, it's really an advanced deposit. I mean, even Airbnb revenues that are paid out afterwards, or depending on how you handle your other OTAs, that revenue is revenue of your owner. So ultimately, that revenue shouldn't even be included in your P&L. Maybe it's a metric that you compare your P&L, your management company revenues too. But if you're not following what we call accrual accounting, meaning, hey, I'm going to take money in and then I'm going to recognize revenue, ideally on some sort of arrival or departure, maybe over the life of the stay, and recognizing, again, your management company revenue and understanding the different components of that revenue that Jacoby just talked about. And even better yet is if you take all those revenues down to the unit, which is really what someone is going to be asking. They're going to want to know, hey, what's your management company for the last 3 years, by month, by type, by unit. If you're just taking cash in and just dumping it on your P&L, and there's really no way to reconcile between what's happening within your PMS to what is landing on your P&L, and or not understanding your balance sheet. Let's say you're commingling funds and you're not following trust accounting, and so it ends up looks like you've got a huge cash balance, but all that money, or maybe you have more liabilities, be it liabilities being advanced deposits, money owed to owners, sales tax liabilities, etc., then you have cash in your bank. Well, that's a big red flag. Your financial house is not in order. And so certainly almost every deal that I've been brought into to do, this early due diligence, kind of pre-due diligence, so to speak, for the seller, we find those types of issues. And so, and there's two problems with it. I mean, really, people don't have the right information to drive a higher valuation for the company just as they're operating it, right? Just higher cash flows, higher profitability means more money back to you, but then eventually a higher valuation. And then again, when you go to sell and that house isn't in order, there's just going to be a lot of questions coming, and it's going to be hard and it's going to be painful, and it could turn any deal that you might potentially have south.
Yeah, definitely. We have a question from Harrison Yatt. Are you seeing transactions where the company owns the assets? Is that becoming more prevalent? So I think this kind of goes back to what we were talking about, maybe the market situation, but I did want to make sure this question got.
Yeah, I'm assuming that this is coming from where, and Jacoby, I'd love to hear your take on this from a deals perspective. I can tell you from our perspective, we certainly have over the last year and a half, 18 months, 2 years, seen a higher prevalence of our clients being what we call owner operators, where they both own and operate the assets. And there's a lot of advantages there, being somewhat vertically integrated, or in some way, they bring on investors to go buy additional homes that they then are the management company for. And so anyway, I know in my experience, I've seen a higher prevalence in that type of company. So I would assume that that's leading into deals where the assets are actually owned as well. My take is, hey man, owning real estate is never a bad deal, but Jacoby, I'd love to hear your take.
No, that's great. And to step on that, like, we're not even to take a baseball reference, we're not even in the early innings of this asset owner operator. We're in like spring training here. Right. We are so early on with this. But what I would say is definitely separate the two companies. So have your propco, have the property company that's buying the assets, and then have the opco, the management company that's managing the assets. In terms of these trading yet, we have seen that there was a great conference a couple months ago called IMN in Austin, and they're kind of doing a short-term rental one. And there was a lot of institutional capital asking questions about that.
Yeah.
So what I would say is if you don't have scale with your propco, and what I would say for scale is probably 50 units or more, then your homes are likely just going to trade retail, just what they would typically sell for. There's not going to be a huge kind of lift you're going to get because it's operating as an asset. But I think that might change in the next couple of years. And then we're seeing the beginnings of some of these institutional groups trying to buy 50 or 100 at one time from some of these people that have started buying those, but it's still so new. So there's not great stuff on it, but I would assume it'll just start trading on caps similar to what long-term rentals did a couple years ago.
And I want to talk about, you talked about having your property co separate from your PMC. I'm going to do a bit of a shameless plug, because we have a lot of people that come to us with that type of structure. It ends up being somewhat complex. They might have multiple investors in different groups of assets, and those end up being separate property holdcos. And people end up trying to do that like in a QuickBooks environment. You start getting to that multi-entity structure, you need more robust technology from a reporting standpoint and accounting standpoint. That's where we use Sage Intacct to help those types of companies. Where we have companies that have 8 to 10 to 12, and that's just really important to be able to support that type of reporting and separate it like you talked about. And the only thing that I'll add to your last point, Jacoby, in let's say the multiple increases, because I'll use a term called vertically integrated, because what we see is that now we've got property holdco. I might have a property management co, and then I might have like a real estate development and or design company. And so where we have seen, I actually have one company, really large company, going through a deal right now where it's a family office. And, they're getting a really good valuation, because not only do they have all the PMC revenue, but they also have other, construction revenue, design business that they're getting from, all these other propco companies that they're going out finding investors to go buy additional properties. So anyway, it's new, but it's as far as I can see, man, it's on the rise.
Yeah, I love that niche, and we don't have to go too deep in it, but the PMC, you can control the interior of the unit. Finally, you don't have a third party homeowner that you're always kind of arguing with about whether to replace their 1990s carpet or something of that nature.
Right.
Thanks, guys. We did get another question. It's kind of a long one, so I'm going to try to condense it so we can keep moving. But how do valuation multiples change as a market matures? He's looking for a comparison for this market to things like warehouses and storage units. Do you guys have any comment to that?
Well, I'll just say that I think we've seen the multiples in this industry increase pretty significantly over the last couple of years. The industries that he's comparing them to, I'd love to know Jacoby's take, but those are typically pretty safe real estate type markets or industries. And so, I don't know that you're going to quite see the multiple, but I think they're usually real estate deals versus this, where it's more of a, at least most PMCs that we're talking about are a service-based contract and sell. So I don't know if they're really comparable.
I agree. Yeah, it's a little bit of apples to oranges here. We're talking more about these are businesses without real estate assets, but it's all a basic economics. The more buyers that get into the industry, typically the valuations will rise some, and we've seen some of that, and a lot of that also depends on the bigger the companies get. So the higher their EBITDA, typically the multiples go with that. And so as our industry keeps growing, there's going to just be more and more larger companies, unless they all get bought by one or two.
Okay, we're going to move on. Jesse, you kind of touched on the P&L, COGS, and so let's just dive right in. You're the expert. What are clean financials? How are you helping vacation rental managers look more attractive to their buyers?
Well, I think more than anything, and I've actually had several folks in the industry come to me and ask that we begin to help standardize the P&L, chart of accounts, et cetera, for this industry, because there really is none. If you look at the hotel industry, it has its own, food and beverage has its own, kind of standardized P&L and chart of accounts, et cetera. And so, we've largely tried to do that. I think, what I'm showing here, I think is certainly accepted as best practice in the industry, which is, I talked earlier, hey, your rental revenue is not your management company revenue. Certainly if you have a propco, that's a different story, that's a different matter, but we're really talking about selling a property management company today. Rental revenue is a part of your P&L. That's your owner's P&L. Or your owner's revenue. And so every dollar in really becomes instantly a payable out to your owner, less your income, which is management commissions or cleaning fees, if that's coming back to you, maintenance revenue. As you charge, let's say, the owner for different maintenance revenue, or perhaps different supplies fees that you're charging your owner. And then you might have other ancillary guest revenue that is flowing back to you, that being damage waiver fees, booking fees, maybe you take late check-in, check-out revenue, pet fees that probably are going to roll somehow into cleaning fee revenue. But really understanding those things, and and at the top I have accrual method, because it's just so important that you're recognizing your revenue on an accrual method. One, that is what a buyer is going to expect. That's when you're earning the revenue. So when I say accrual, it means, hey, cash in doesn't mean revenue. What means revenue is you've earned it, and that means when the guest stays and you've managed that guest. And one, that lets you know, hey, when am I earning the revenue? But we also, in accounting, we talk about matching expenses with revenue. And so the other piece of the puzzle is, so that's why we do accrual revenue, because we're going to incur a bunch of expenses, OTA fees, pricing tool costs. I have some of the direct costs, and understanding what is a direct cost versus an operating cost is also something that's very important. I've put in here typical things that we include in cost of revenue and or direct costs. Those terms can be used interchangeably, but OTA fees, VRBO commissions, booking.com commissions, Airbnb fees, all those things that are expenses to you, plus pricing tools or direct labor to service as you're managing those guests. And then when we look at cleaning, hey, what are all the things that go into cleaning a home? Your labor, your supplies, your linens, laundry, etc. Same thing with maintenance. I don't have in here other costs of revenue, but certainly there's probably going to be some sort of other costs directly associated with earning your ancillary guest revenue. So what we want to know is, hey, I've broken down all of my management company revenues. Again, very key. Even better is if we have that by unit. Cost of revenue, same thing. Hey, what are direct costs associated with earning that revenue? And again, if I can get that down to the unit, fantastic. Even better. And then understanding your margins on each one of those. Typically, we'll break it out almost like as departments, so we understand the profitability of each of our departments. I see way too many people that lose money on cleaning, for example, because they're not taking into consideration like the cost of supplies and linens or laundry, or they're not charging their owner for linens. Really understanding your profitability on a per item basis, and then overall, hey, what's your gross profit as a percentage of rental revenue? You can see here I have that computation on rental revenue on the right. I'm always interested, and I guarantee a buyer is going to be interested in, hey, for every rent revenue dollar that you bring in, how much of that revenue is is gross profit to you. So here we're about 30%, meaning for every dollar in rent revenue, I'm taking 30 cents, not necessarily my bottom line, but to my my first margin. And so healthy companies that we see are, at least at the 25%, up to 35, sometimes over. But hey, understanding where you're at there is very, very important. And then, the second part is, hey, what are your fixed costs? And same thing, there I've got fixed costs as a percentage of that rent revenue number, so that I can understand, hey, as I add revenue, I probably am going to see some of these costs go up, but hopefully not as much, right? So ideally, I can understand my fixed costs on an per property basis, so I can begin to understand, really, as we scale and as we grow, ideally our fixed costs don't grow as much. And so that's where you get into scalability and economies of scale, so to speak, because, and you can also see here that I've actually broken out our payroll by department. We work on tracking that for all of our clients, because payroll, and Jacoby will speak to this, is your biggest expense. And so controlling and understanding and how are you efficient from your operation standpoint, so that your payroll is as low as a percentage of revenue as possible, is very important to drive that ultimate bottom line, which again, we tell all of our companies, hey, your net income should be 5% at minimum of gross rent revenue. Ideally, you are, 8 to 12 or even higher. But if you're between the 8 to 12 mark, you're, in our opinion, you're achieving what you should. But anyway, I'll throw it back to you, Jacoby. I know I just probably got way too technical. This is much more of a accounting exercise than anybody ever imagined. But anyway, I'd love to get your take.
No, that was great. I really don't have a ton to add to that. I think if a company has what we're looking at right now, a P&L that looks like this, you're doing better than 75, 80% of your peers in the industry already. So please start focusing on this today. Showing your direct cost of revenue, breaking those out, breaking out your revenues. Then you can see your fixed costs, breaking out the payroll. As Jesse alluded to, we see that staffing, that your payroll is your largest expense. So understanding what departments either you need to grow with, or might need to be shrunken down based on kind of what your budgets are. But having a P&L like this with the margins broken out, it's beautiful.
Yes, it is a beautiful thing.
At least to an accounting and finance nerds, they are. It's beautiful.
We do have a question from the audience before we get to the question on the screen, which is, can you give us an idea of the size of deals that are happening right now? If you have clean financials, is there little to no retrading happening during the deal? Or is there just an expectation that you're going to have to go back and you're going to have some cleaning to do?
No, good questions. And I would say retrading it should be rare. Every deal is super nuanced and personal and all of that. If you're running a clean company and you're aware of your inner workings, you're going to be fine. There likely won't be retrading, but that could happen if you do have some red flags that come up. In terms of valuations, I could obviously talk about this for a long time, but typically we see $1 million and less of EBITDA. It falls in that 3 to 5x range of your last 12 months financials. And there's a lot of different things we could talk about.
3-5x of what, Jacoby? 3-5x of management company revenue, or 3-5x of EBITDA?
Oh, sorry, 3 to 5x of EBITDA. Good question. Which is your net income, and then before interest, taxes, depreciation, amortization, and it's your adjusted EBITDA. So if there are one-time non-recurring expenses, or if your owner's salary is in the P&L and you are not If you're a passive employee, then you could remove that as well. But if you are active in the business, then that would need to stay in. But that's what we're seeing right now. Or we're seeing around a 1 to 1.25x multiple of your revenue, of your last 12 months revenue as well.
And that would be management company revenue. Is that correct? Or is it rent revenue?
That would be management company
Right.
revenue. Correct.
Yep. So knowing the difference.
Yeah. So management company is not going to include that rent revenue. And so that's why, and it's so important to understand, hey, what is your management company revenue and not including that rent revenue in that top line. In some ways it kind of tricks you, right, into thinking, it's not really your revenue. But
great. Thank you guys. We were talking about costs and revenue and how that makes you look as a seller, but you also have to think about the balance sheet, right? Because that's where you're going to see risk. You've got your assets and liabilities. So Jesse, what are some of those key items that we need to consider on the balance sheet?
Well, I think you can jump to the next screen, which we've put up here. What is typically your biggest assets and liabilities on your balance sheet are associated with what we call trust assets and trust liabilities. And, the term trust kind of gets thrown around a lot. But I always like to break it down very simply that you should have a separate bank account where you're not commingling funds that are being received for advanced deposits, paying out owners, et cetera, with your operating cash. And there's from a regulatory standpoint, there's several states that require that. But then if we talk about trust accounting, taking it a step further, so if that's my trust asset, I've separated that cash out, which basically trust means, hey, this is a bunch of cash that I really don't own. I'm holding it on behalf of other people. Then the question is, okay, well, who are those other people? Who are those? What are the liabilities associated with those assets? And so my bank account balance, my trust bank account balance should equal my trust liabilities, and those liabilities being your advanced deposits, your amounts payable to owners. So at the end of the month, all that revenue is recognized through the month you have not yet paid out. That is a owner payable or owner AP. You obviously have sales tax liabilities, most likely, and then you also have perhaps other AP for vendors. Maybe they've been deducted from the owner statement, but you have AP that's owed to other vendors, and then obviously you owe yourself some money. So some of that money in that bank account is probably yours. And so understanding that reconciliation, because your trust asset and your trust liabilities are likely your biggest components of your balance sheet. And the last thing not the last thing, but the last point, I guess, on the trust accounting piece is by not commingling your funds, by making sure that you've separated out your operating cash from your trust bank account, is that you better understand your cash position and your cash performance. Too often I see people, cash is just flowing in, they're commingling funds, and they're just, they treat their trust account like a line of credit. And what you end up happening is that you're fooled. You're fooled by the idea that hey, you don't have the money in the bank to pay out all those liabilities, and most of the bank most of the cash in the bank isn't yours, and so you are not. You don't understand your true cash position, and then when, from a seasonality standpoint, you get in trouble, or and I've seen it. I've had companies actually I've had to fire because I said, hey, you guys are not adhering to best practices, and you're high risk, and so we've got to we're not going to be able to work with you anymore. And so understanding those trust assets and trust liabilities is the biggest piece of it all. But But, you know, other things obviously is your own AP, you know, your own operating cash balance, understanding, you know, your quick ratios, such as current assets to current liabilities. And, you know, the understanding your balance sheet, making sure you don't have hidden expenses on your balance sheet. Maybe you bring something in and you dropped it in like a prepaid expense account, and you never amortize it out. So now you've got a hidden expense on your balance sheet that is going to come out during a QOB exercise, or you know, you've got off balance sheet liabilities. You know, you took a bunch of cash and somehow, you know, that's a liability, and you threw it in equity instead of recording a liability. You know, those types of things, if not accounted for correctly, can really, you know, cause problems when you're going through that sale process.
Yeah, Jacoby, Jesse mentioned that if your liabilities, you know, you could be over or under. Is there a threshold for materiality of that percentage? You know, is it better to be perfectly at zero? Is it better to have a little bit extra on the upside? What are your thoughts?
Yeah, I think I don't know if there's an exact threshold that we see, but I would just say, just generally having a little bit more in your bank account to your liabilities would probably let you sleep better at night, or at least make me sleep better at night. That's for sure. And we live, a lot of these companies are in areas where natural disasters happen. Hurricanes, they happen all over the coast. So if you are commingling, or you're using, as Jesse said, like the trust account as a line of credit during slow season, then a hurricane hits, like you can get in a world of trouble really quick and upside down quite quickly. And going a step further, if you are doing a deal and you don't know what your actual trust account should be at, and it's not fully funded, then one, that's a level of trust that some buyers will just walk away from the deal at that point. But if they don't, then they'll reduce the purchase price by the amount that it takes to fully fund that account. Yeah. So you need to be aware of those as well.
Hey, Mary, I know we're coming up against the top of the hour here, so we might want to skip the last question, which is unfortunate. But if people have questions, you know, right now would probably be a good time to ask it if anybody has any other questions. And then, you know, we've put up here, hey, you know, you can reach out to us at Ximplifi directly on our website, ximplifi.com, or Jacoby, I think we've got your email address down at the bottom to let people where to know if they need help with any of, you know, these issues, whether it's getting books in order, preparing for sale. You know, we'd love to connect with you and hear from you about how we can help.
Yeah, thanks, Jesse. Great wrap up. I just wanted to throw out there that you both will be at the VRMA International Conference in Vegas. So if you guys are attending, please stop by our booth, stop by C2G's booth, and these are the contacts. We will be sending out the recording. I think a lot of people must have had a late flight, and so we're going to give them the benefit of the doubt and send them the recording. But great job. Thank you, Jacoby. Thank you, Jesse.
Yeah, no problem. It was enjoyable to do this, I guess, on a session, since, you know, we largely do it every time we get together, talk about our horror stories of, you know, deals gone bad. Maybe, you know, I think it could be like a Saturday Night Live skit or something.
For sure. Thank you, Mary, for setting this up.
Of course. Let's do it again soon.